What if I told you that a simple three-digit number could be the key to building a retirement fund of over 2.5 crore rupees? It's called the 555 rule. Now, this isn't some get-rich-quick scheme. It's a mathematical blueprint. And in this video, I'm going to break down the exact numbers and show you, step by step, how this powerful mutual fund strategy can work for you, starting with an investment of just 5,000. We'll get into how it works, why it works, and most importantly, how you can start today. Let's be honest, retirement can feel like a lifetime away. And the idea of saving up a multi-crore corpus sounds like something for the financial elite, not for those of us with a regular monthly salary. We're always told to save for the future, but the path often looks incredibly complicated. It's a jungle of jargon, expense ratios, alpha, beta, rebalancing, asset allocation. It's enough to make anyone feel overwhelmed, and even worse, just put it off. But procrastination is the silent killer of wealth. It's that little voice whispering, "I'll start next month," or "I'll invest when I have more money." Every single month you wait, you are robbing your future self. You're not just losing the money you could have invested, you're losing its potential to grow and multiply while you sleep. The cost of delay isn't measured in thousands or lakhs, but in crores. It's one of the biggest financial mistakes you can make. The financial world can feel like an exclusive club designed to keep you out. We get bombarded with so much information that it leads to analysis paralysis. We're scared of losing our hard-earned money in a volatile market. We think we need a huge lump sum to even begin, so we wait for a bonus that might never come. But what if there was a way to cut through all that noise? A simple, elegant rule that gives you a clear, actionable path. A rule that doesn't require you to be a financial wizard or have massive starting capital. That's exactly why we're here. We're going to demystify this whole process. It's time to meet the hero of our story, the mutual fund rule of 555. This rule is your answer to overwhelming complexity and your weapon against procrastination. So stick with me, because understanding this one concept could be the most profitable thing you do all year. Section 1. The what? Unveiling the 555 rule. So, what exactly is this rule of 555? It's not magic, it's a disciplined investment strategy, a simple blueprint for creating wealth that anyone can follow. The beauty of the 5-5 rule is its simplicity. It breaks down the huge task of building a multi-crore fund into 3 easy-to-remember parts. Let's break down each 5. The first 5 stands for Rs 5,000 per month. This is your starting point, the seed you plant for your future. The rule suggests you start by investing Rs 5,000 every month through a systematic investment plan, or SIP. Why Rs 5,000? For many people, especially early in their careers, it's an amount that's meaningful but not intimidating. It's often the price of a few nice dinners or a new gadget. By redirecting that money into an investment, you're choosing to prioritize your future. Think of it as a starting block. If you can afford more, great. If you can only start with less, that's fine too. The key is to start with a manageable amount and be consistent. This first 5 is all about taking that first step and building the habit of disciplined investing. The second 5 represents retiring at age 55, which for someone starting at 25 gives you a 30-year investment horizon. This is probably the most critical part of the whole formula. Time. The 5-5 rule is built on long-term investing. It's not about timing the market. It's about time in the market. 30 years might sound like forever, but it's the runway your money needs for the real magic to happen. This is the period where your money starts working for you, generating earnings, and then those earnings start generating their own earnings. This second 5 isn't just a number. It's a commitment to patience. It's about planting a tree and having the wisdom to let it grow for decades, knowing the biggest rewards come in the final years. Now for the real accelerator. The third 5 stands for increasing your monthly SIP by 5% every year. This is the part that supercharges your portfolio and separates a good plan from a great one. This annual increase is often called a step-up SIP. Why 5%? For most salaried professionals, a 5% annual increase is a conservative and achievable target, often less than the average salary hike. If your income grows by 8 to 10%, increasing your investment by just 5% won't feel like a pinch. But the impact this small increase has on your final corpus is incredible. This third 5 aligns your investments with your income growth, helps fight inflation, and dramatically speeds up your journey to that multi-crore goal. So to recap the rule, start a SIP of Rs 5,000 per month. Stay invested for 30 years, e.g., from age 25 to 55. Increase your SIP by 5% every single year. This 3-part formula is your roadmap. It's simple, easy to implement, and as we're about to see, incredibly powerful. Section 2, the how and why, the math behind the magic. All right, this is where we move from concept to concrete numbers and see the 555 rule in action. To do this, we need to make one important assumption: the expected rate of return. The 555 rule is usually calculated assuming a 12% compound annual growth rate, or CAGR. You might be thinking, is 12% realistic? It's a fair question. Historically, equity markets in India have delivered returns in this range over the long term. For instance, over the last 20 to 25 years, the Nifty 50 Total Returns Index has delivered a CAGR of around 13 to 14%. So, assuming a 12% CAGR from a diversified portfolio of equity mutual funds over the long run is reasonable. Of course, it's not guaranteed. Markets are volatile. But it is a historically grounded average. Part A. The power of compounding without the step-up. First, let's see what happens if you only follow the first 2 parts of the rule. Imagine you invest a flat Rs 5,000 every month for 30 years at a 12% CAGR. Monthly investment, Rs 5,000 investment. Duration, 30-year 360 months. Expected CAGR, 12%. Over 30 years, your total investment would be Rs 5,000 times 360 months, which is Rs 18 lakhs. And what would this grow to? Using a standard SIP calculator, this investment would grow to approximately Rs 1.76 crore. Think about that. You put in Rs 18 lakhs over 3 decades, and through the power of compounding, it becomes Rs 1.76 crore. Your money earned you nearly Rs 1.58 crore. That's the magic of compounding. Your money making money, and that money making even more money. Notice how the growth accelerates over time. After 10 years, you'd have about Rs 11.6 lakhs. After 20 years, it grows to around Rs 50 lakhs. But in the final 10 years, your corpus skyrockets to Rs 1.76 crore, adding a staggering Rs 1.26 crore in that last decade alone. This is because in the later years, the returns are generated on a much larger base. This is why starting early is so critical. Part B. Supercharging with the 5% step-up, the full 555 rule. Now, Rs 1.76 crore is fantastic, but the 555 rule promises over Rs 2.5 crore. Where does that huge difference come from? It comes from that seemingly small third 5, the 5% annual step-up. Let's rerun the numbers with the complete rule. Initial monthly investment, Rs 5,000 investment. Duration, 30-year annual, step-up, 5%. Expect CAGR, 12%. Here's how your investment changes. Year 1, you invest Rs 5,000 per month. Year 2, you increase it by 5% to Rs 5,250 per month. Year 3, you increase it again to Rs 5,512.50 baht per month, and so on. This might seem minor, but it has a seismic impact. With this strategy, your total investment over 30 years isn't Rs 18 lakhs anymore. It adds up to about Rs 39.8 lakhs. You've invested more, Yes, but look at the final amount. That investment, compounded at 12%, grows to approximately Rs 2.64 crore. Let's put that side by side. Flat SIP. Invest Rs 18 lakhs. Get Rs 1.76 crore step-up SIP E. 555 rule. Invest Rs 39.8 lakhs. Get Rs 2.64 shura crore. The difference is a mind-boggling Rs 88 lakhs. By investing just Rs 20.8 lakhs more over 30 years, you gained an additional Rs 88 lakhs. Every extra rupee you invested through the step-up generated more than 4 rupees in extra returns. That's the incredible power of the step-up. It's like adding a turbocharger to your investment engine. Part C. The assumptions. A reality check. It's important to be clear about the assumptions. The Rs 2.64 crore figure is a projection, not a guarantee. It hinges on that 12% CAGR. Could returns be lower? Yes. They could also be higher. The key is to stay invested through the market's highs and lows to capture that long-term average. The second reality check is inflation. That Rs 2.64 crore in 30 years won't have the same purchasing power as it does today. Assuming an average inflation of 6%, that future corpus would feel more like Rs 46 lakhs in today's money. That's still a very significant sum for a comfortable retirement, but it's crucial to have that perspective. Finally, what about the 5% step-up? Life happens. You might have a year with unexpected expenses and can't increase your SIP. That's okay. The plan is a guideline, not a prison. The goal is consistency over perfection. Missing a year or two won't derail you, but sticking to it most of the time will have an enormous impact. Just pausing here for a second. We've just seen how a simple rule can lead to a multi-crore corpus. If you're finding this helpful and want more practical, no-nonsense financial strategies, do me a favor and hit that subscribe button. It's free, and it's the best investment you can make in your financial education. Section 3. Practical application. Putting the 555 rule to work. Theory is great, but it's useless without action. So, how do you actually implement the 555 rule? Let's get practical. Step 1. Where to invest. Choosing the right mutual funds. The rule assumes a 12% return, which historically points towards equity mutual funds. With a 30-year horizon, you have time to ride out market volatility, making equity the right choice. But which funds should you consider? Nifty 50. Index funds. This is probably the best starting point for a new investor. An index fund simply mimics a market index, like the Nifty 50, which is made up of India's 50 largest companies. You're essentially buying a small piece of all of them. The benefits are huge. Instant diversification, extremely low costs, and your returns will closely follow the market. Flexi-cap or multi-cap funds. These funds give the fund manager more flexibility to invest across companies of all sizes, large, mid, and small cap. This can potentially lead to higher returns, but it also comes with slightly higher risk and depends on the fund manager's skill. A balanced approach. A simple, effective strategy is to split your Rs 5,000 CP, for example, Rs 3,000 sounds in a Nifty 50 index fund for stability, Rs 2,000 chains in a well-rated flexi-cap fund for extra growth potential. This gives you a solid foundation with a bit of a booster. When choosing funds, look for a consistent long-term track record, a low expense ratio, and a reputable fund house. Remember, this isn't specific advice. You must do your own research. Step 2. How to set it all up. Setting up a step-up SIP is incredibly easy today. Here's how. Choose your platform. You can invest directly via Asset Management Company, AMC website, BDs, or use popular apps like Zerodha Coin, GrowW, Kuvra, or ET Money. Complete your KYC. If you're new, you'll need to complete the one-time Know Your Customer KYC process with your PAN, Aadhaar, and bank details. Select your funds. Choose the 1 or 2 funds you want to invest in. Set up the SIP. When you invest, look for the SIP option. Here's the crucial part. Enter your starting amount, e.g., Rs 5,000. Look for an option called Step Up SIP, Top Up SIP E, or SIP Booster. Enable it and enter the step up details. Step up a percentage, 5%. Step up the frequency, annually. Authorize the mandate. Set up a one-time bank mandate to allow auto debits each month. That's it. You've put your wealth creation on autopilot. Step 3. Monitoring and rebalancing. The gardener's approach. Automation is powerful, but it's not set and forget forever. Think of yourself as a gardener. You've planted the seeds, but you still need to tend to the garden. Once a year, review your portfolio. The goal isn't to chase performance, but to ensure your plan is on track. The main task is rebalancing. Over time, your asset allocation will drift. If equities do well, they might become a larger part of your portfolio than intended. Increasing your risk. Rebalancing is just bringing your portfolio back to its original allocation. It's a disciplined way to book some profits when the market is high and reinvest where it's cheaper. For most, an annual check-in is enough. Section 4. Customizing the 555 rule. What if I'm not 25? The 555 rule is a great template, but what if your story is different? The principles still work. We just need to adjust the numbers. Scenario A. I'm 35. Is it too late for me? It is never too late to start. However, the cost of delay is real. If you start at 35 and retire at 55, you have a 20-year horizon, not 30. Applying the 555 rule, starting at 35, initial SIP. Rs 5,000. Duration, 20 years. Step up, 5%, annually CAGR, 12%. Your investment would grow to approximately Rs 80 lakhs. That's a great corpus, but it's a far cry from Rs 2.64 crore. That shortfall is the price of a 10-year delay. To reach the same Rs 2.64 crore goal in 20 years, you'd need to start with a monthly SIP of roughly Rs 16,100. This shows why starting early is your biggest advantage. Scenario B. I want to retire early at 50. Let's say you're 25, but want to retire by 50. That's a 25-year horizon. To reach the same Rs 2.64 crore corpus by age 50, you'd need to start with an initial monthly SIP of around Rs 9,500. The rule is flexible. If you shorten the time, you have to increase the contribution. Scenario C. I can invest more than Rs 5,000. What's possible? This is a fantastic position to be in. The 555 rule is a starting point, not a limit. If you start at 25 and follow the rule for 30 years, start with Rs 10,000 month. Your final corpus would be an incredible Rs 5.27 crore. Start with Rs 15,000 month. Your final corpus would be a staggering Rs 7.91 crore. Start with Rs 20,000 month. You'd be on track for over Rs 10.5 crore. These numbers show that creating serious wealth isn't about a secret stock tip. It's about discipline and consistency over time. So a question for you. Based on your age and goals, how would you adapt the 555 rule for yourself? Let me know in the comments. Section 5. Addressing objections and common mistakes. Following a simple rule for 30 years sounds easy, but your biggest enemy won't be the market. It will be your own emotions. Let's tackle the biggest wealth destroyers so you can avoid them. Mistake 1. Panicking and stopping SIPs. During a market crash. This is the #1 mistake that kills long-term wealth. Market crashes are inevitable. When you see your portfolio drop 30%, your gut reaction will be to panic and stop your SIPs. That's the worst thing you can do. Think about it this way. When your favorite phone goes on a 30% off sale, do you run away? No, you get excited. A market crash is a sale on high-quality assets. Your fixed SIP amount is now buying more fund units than before. This is called rupee cost averaging, and it's your superpower as an investor. Continuing your SIPs during a downturn is how you set yourself up for the biggest long-term gains. Mistake 2. Stopping the 5% annual step-up. The 5% step-up is the plan's turbocharger. It's easy to neglect. But as we saw, that small increase is responsible for nearly 1/4 of the final corpus. Stopping the step-up is like deciding to run a marathon, but walking the last 10 kilometers. You might finish, but you won't reach your potential. Automate it so you don't even have to think about it. Mistake 3. Fund collecting or over-diversification. As you get more comfortable, you might be tempted to add more and more funds to your portfolio, chasing the latest top performer. Soon, you have 15 different funds. This is a huge mistake. Too many funds doesn't reduce risk. It just ensures your returns will be average. It's like cooking a meal by throwing every spice you own into the pot. For a long-term goal, a portfolio of 2 to 4 well-chosen funds is more than enough. Keep it simple. Mistake 4. Ignoring taxes and inflation. Your real return is your investment return minus inflation and taxes. While our calculation is pre-tax, be aware of the tax implications. Currently, long-term capital gains from equity funds are taxed at 10% on gains over Rs1 Lake in a financial year. It's a relatively low tax rate, but you need to factor it in. And always think in terms of purchasing power. The goal isn't a number, it's a lifestyle. We've covered a lot today. We started with the overwhelming problem of retirement and introduced a simple solution, the mutual fund rule of 555. Let's recap it one last time. Start a monthly SIP of Rs 5,000. Commit to a long-term horizon, like 30 years, to let compounding work until you are 55. And the accelerator. Increase your SIP by 5% every year. We saw how this discipline can turn an investment of about Rs 40 lakes into a corpus of Rs 2.64 crore core. We walked through how to set it up, how to customize it, and what mistakes to avoid. The 555 rule isn't a magic trick. It's math. It proves that building a multi-crores retirement fund is possible for anyone with discipline and patience. The most important takeaways are to start early and be consistent. You don't need to be a market expert. You just need to show up month after month and let the system work for you. The goal isn't just a number on a spreadsheet. It's what that number represents. Freedom. The freedom to choose how you spend your time, free from financial anxiety, and to live your post-work life with dignity and security. Your journey to financial freedom can start right now. It can start with Rs 5,000. The best time to plant a tree was 30 years ago. The second best time is now. Thanks for spending this time with me. If you found this video valuable, please give it a like and subscribe for more in-depth financial guides. Keep learning, stay disciplined, and start your journey today.